A very good morning. Shri BP Kanungo, Director Kafral, Professor Bharat, Director IIM Ahmedabad, faculty members of IIM Ahmedabad and Kafral, distinguished participants, researcher of this conference, a warm greeting to all of you. I am delighted to be present here at the International Research Conference on FinTech. The theme of the conference, innovation, inclusion, and regulation, in the context of the FinTech revolution in India, is indeed very topical and relevant at today's time we live in. New technology often reinvigorates and reshapes economies. In the last few decades or so, as talk about Professor Bharat, the information technologies perhaps had the most transformative effect on the economy and particularly in financial services. The interlinkage of finance and information technology, which is now known as FinTech, has played significant role in the evolution of finance. Over the years, technology has led to globalization of financial services, initiated a tectonic shift in the efficiency and speed of these services, and increased convenience as well as better experience to consumers. What makes the FinTech so different? Let me explain a little bit. The current FinTech revolution, which started soon after the North Atlantic financial crisis of 2007-8, and usually we call it GFC, is unique in many ways. This revolution is defined by the increased computing power, use of new technologies such as artificial intelligence and machine learning, APIs that leverage big data in providing financial services. Further, there is an emergence of new entrants and new business models. Prior to current FinTech revolution, digitalization of financial services allowed banks and financial institutions to have structured data on their consumer, which was used to have better understanding of the customer's risk profile. I'm talking about 1980s and late 1980s when the CBS system was implemented in the banking system, which helped in doing the transaction. And that created a huge database with the banks, but banks were able to have a risk profile of the customer. But whether they were able to use it for their business strategies and the business proposition, probably it's a more long way for them to go. However, with the emergence of big data analytics, even better insights on customer preferences and behavior can be obtained using alternate semi-structured and unstructured data. That is the piece where the banks and the regulated entities really need to collaborate with the FinTech and the new technology innovators. Moreover, the analytics, rather than being performed by the financial institution themselves, is being outsourced to new age FinTech. In fact, the financial sector is benefited from this synergistic collaboration between the regulated entities and FinTech with huge future potential. It's only the beginning. It's having a huge future potential if it is done in a proper manner and a pragmatic way. Let me talk about what benefits from the FinTech really have accrued and realized. Professor Bharat has already explained, and Shri Kanungo also explained in his address. So Professor Bharat also, is not only the volume, it's the basically scale, speed, and the secure. And that's the beauty of the Indian payment system, which is now being looked after by the global leaders, that how India has really developed and evolved its entire payment system. And all three are very important, the scale, speed, and the secure. One of the key value proposition that fintechs offered was providing the same financial services as regulated entities, but at a lower cost. That's the area where the fintechs are entering into the traditional banking and the traditional financial services because of the cost advantage. Fintech disruption in Indian brokerage industry is a shining example of this. Large technology companies, and that is the new area. Large technology companies or big tech, so we called it big tech, as they are popularly called, such as Alphabet, Meta, Amazon, etc., have also expanded into financial services. These companies leverage the data from their large existing user base, coupled with network effects, to provide contextualized or embedded financial products along with non-financial products. And that is where basically I feel that the data and technology will be the game changer for all the economies, the way economic power and the other power is being created and generated by various countries. I feel data is the wealth. And once we are able to have the huge data, it can make changes in the day-to-day life of the people. It can influence the behavior of the citizens. And that is where probably these fintechs, particularly the big tech, are really making inroads in a big way. Now, let me talk about certain risks from the fintech. Those are the benefits what we have talked about it. Briefly, let me touch about, and that is where certain basically aspects I will cover on the inclusion as well as the regulatory approaches, because that is the topic: innovation, inclusion, and the regulation. Irrespective of the type of player undertaking financial business or the type of technology underlying it, it is prone to few fundamental sets of risk. For regulated entities or new entrants, depending on the business model, they face legal, reputational, governance, and operational risk. And more important is the reputational risk, in addition to the usual what we call credit market and the liquidity risk. From customers' perspective, key risks include mis-selling, discrimination, data privacy, and security. And that's the big risk. And that is where catching the attention of all the regulators across the globe, as well as various governments. From a regulator perspective, there are risks associated with financial stability, the market integrity, and customer protection. And these are the three bedrock for any kind of regulation. What role RBI is playing out through these risks? We monitor and calibrate our regulatory and supervisory response across these risk areas. However, new entrants and new technologies can further aggravate these risks. For example, fintech operating on lending side have spurred the availability of unsecured loans globally. Such loans are often driven by machine learning models. However, effectiveness of these models for delinquency has not been fully established, especially during an economic downturn. Any significant failure of these models will not only be limited to new entrants, but will also impact regulated entities with exposure to them. So it's basically an interconnectedness. Though directly they might not be exposed, but definitely indirectly they are exposed. Use of models also brings the question of fair treatment in the extension of credit. It is necessary that highly automated fintech business models for decision making take care of requirement of fairness through additional procedures, controls, and safeguards, both in the development and deployment of models and also in the final decision making. Risk of unreliability or vulnerability of the technology is not limited to fintech. It's everywhere. Whosoever is using the technology, they are exposed to those vulnerability as well as the unreliability. And in today's paper, also talking about it, various new technology used through the artificial intelligence, that what kind of danger they may have. So it is having that kind of vulnerability. However, since their business is heavily dependent upon automation, I'm talking about FinTech, their vulnerability is also greater. The FinTech needs to be conscious of customer protection. And that is where we are finding the gap in the Indian operating space. Mis-selling, fraud, or misconduct by FinTechs may harm the very consumers they intend to serve. So that is in their interest, that they have to see the consumers to whom they are serving, whether they are really doing good for them or they are really doing harm for them. The careful management of this risk is significant for the sustainable development of the FinTech sector. A loss of consumer trust may put an unrepayable dent on the sector's growth story. And that is where the regulatory gray area, the FinTechs or any other new entrant can operate for a while. But the moment it is increasing in its size and creating an instability in the system, then definitely it will attract the attention of the regulators. So while regulators are always worried about customer protection, FinTech should even be more aware, vigilant, and proactive in ensuring that the bedrock of their business remains protected. That is in their interest. Now let me talk about the financial inclusion while talking about the innovation and the risk emanating from those new technology and the FinTechs, that how the financial inclusion really the FinTech can make a change. A financial sector that does not prioritize financial inclusion cannot distribute the benefits of economic growth to all levels of society. Financial inclusion entails providing access to avenues of savings and investment and credit at an affordable cost. It benefits the economy and society as it is accompanied by increased economic growth and reduction in inequality. And that is where probably it is catching the attention of the globe, and in the G20 also this is one of the priority area, that how we can bridge the gap in the inequality. Because the kind of capitalism, accumulation of wealth is cornered by few percentage of the people is creating inequality in the societies. So there the financial inclusion is very, very important. The FinTech can play an important role. In countries that have large number of people who are unbanked like India, financial innovation could help enhance financial inclusion, especially if they are paired with digital identification systems. And there basically we have done something, I will come to it. While we talk about the financial inclusion on the access side, we have traveled a long distance. But on the usage side, means the demand side, still there is a long way to go. And that is where on the demand side, mainly it is on the credit, insurance penetration and the pension penetration where we are lagging behind. Probably the FinTechs can really do a lot of work on this space, that how the technology can be used to reach out to the people for improving their livelihood and their income. With the use of alternative data, end-to-end digitalization coupled with other technological intervention, FinTech can bridge the credit gap that exists due to various reasons, such as absence of credit scores, cumbersome documentation, manual processes, etc. And that is where RBI has done a beginning, and I will touch upon it, that with Reserve Bank Innovation Hub, in association with RBI is piloting an end-to-end digitalization of Kisan credit card lending. The project envisages automation of various processes within banks and integration of their systems with the service providers, which will make granting of KCC loans more efficient and economical. That is one area where a lot of FinTechs are doing a lot of work in silos. They are not having enough platform to one, scale it up, and second, to give this basically benefit to the entire country. So that is where we realized that probably the farmer's credit may be the one starting point, particularly when the land record digitalization has taken place. Most of the states have done the land record digitalization, and they are providing through API access to the lending institution. So that's one area. Second, through satellite images, you can very well map the field and the cropping pattern. There are a lot of FinTechs who are really historically collecting the data, and they are able to work out the yield as well as the cropping pattern. Then we are having all KYC related centralized system. So we decided why we should not start this in a proper manner, that there can be a public infrastructure financial tab or the platform which is available, and the banks can come on board and they can fetch the information which is available from various publicly available sources, and then they can work out through a rule-based engine. We did a survey, and in the survey what we observed, the operating cost to the farmer was ranging between 5 to 8%. In addition to that, there was an opportunity loss for them because it was taking around 3 weeks to 4 weeks for them to get a KCC loan. So through this stack, on a pilot basis, the fantastic results, the operating cost came to almost zero. And the speed of giving the credit was brought down from 3 to 4 weeks, though at the initial stage and at pilot, in 5 to 10 minutes. Even if I presume when we scale it up in a larger level, even if it is available in hours, without having any limitation or without traveling from one place to another place, I think that will be a game changer. Our plan is, once it is successful, we will expand this tech platform to all type of credit, particularly to the small segment of the society, those who are at the bottom of the pyramid, so that we can bring them to the financial inclusion. And that is where the power of the technology, if it is used in a proper manner, that it can be transformative. Now let me come to the regulatory approach. There are various regulatory approaches, and I will touch upon a couple of approaches as well as the RBI approach. Any approach to regulate the fintech sector will invariably be informed by 5 fundamental objectives. 1, financial stability, consumer protection, integrity of the financial system, competition, and orderly development of the sector concerned. So all 5 are important. Under these overarching objectives, there are various approaches to regulation. At one end of the spectrum, there is hands-off approach, and that advocates allowing the sector to operate freely and develop without any regulatory intervention. So regulators need not to bother. Let it happen whatever way it has to happen, and then we will see when the time will come. While this allows for harnessing benefit of innovation, it risks the possibility of failing to protect the financial system and customers from adverse outcome. And that's the danger. Probably a few years in the back, the cryptocurrencies was not considered and allowed by various jurisdictions to be freely operated. And now in the last 2 years, everyone is realizing its downside risk and having a larger impact on the economies. At the other end of the spectrum, there is a status quo approach that aims to maintain the existing framework without any relaxation to cater for new developments. Under this approach, fintech products and services are regulated in the same way as the traditional financial product or services. From the perspective of controlling risk, it may appear to be the best approach as it applies tried and tested regulation. However, benefits of innovation may be lost. So both approaches are not good to our understanding and what we feel. In India, the RBI has endeavored to find a middle ground, trying to balance between the innovation brought by fintech while addressing the unique risk they introduce. And that is the approach we are adopting, and that's an adaptive approach. The NBFC, I will give few examples. The NBFC Account Aggregator Framework of 2016, NBFC Peer-to-Peer Lending Guidelines of 2017, and recent digital lending guidelines are examples of adaptive regulation intended to address emerging risk while allowing the innovation as well. Another example may be P2P regulations were introduced as early stage, allowing India to avoid failures witnessed in other jurisdictions, while at the same time enabling an innovative mode of credit intermediation. And that is where we started long back, while the other jurisdictions were really facing the heat of these innovations. Similarly, guides on account aggregator facilitate innovations related to open banking while building a robust data privacy regime. Last year's digital lending guidelines was a reiteration of 2 well-established principles, and that is, lending business is a regulated activity. That's the basic fundamental principle. And onus of ensuring compliance in an outsourcing arrangement lies on the regulated entity. And that is where we have seen the gap. The RBI introduced the regulatory sandbox framework in 2019 for live testing of innovative products or services in a controlled environment. The success stories emanating from the regulatory sandbox initiatives include the recently launched UPI 123 Pay, which can enable more than 400 million feature phone users to make UPI payment even without having an internet connection. Further, to extract the full benefit of regulatory sandbox, a framework for interoperable regulatory sandbox was also unveiled last year, and that is basically across the financial regulators. This framework is to facilitate testing of innovative product services falling within the regulatory ambit of more than one financial sector regulators. In 2022, as part of efforts to promote innovation in the financial sector, the RBI set up the Reserve Bank Innovation Hub, and that was again basically with an intent to develop the innovation, and that was the unique thing done by RBI. Within RBI, a new FinTech department that also, because except having a innovation hub won't serve the purpose unless until we are having the capacity building within the RBI itself. So within RBI, a new FinTech department was established in 2022 at the same time to give focus attention to this evolving sector. Its objective is to not only promote innovation in the sector, but also identify the challenges and opportunities associated and address them in a timely manner. Within the regulatory envelope, activity-based regulation as opposed to entity-based regulation is gaining traction across the globe, and that is attracting the attention of RBI as well. Entity-based regulatory requirements are prudential, conduct, and governance related to the regulated entity rather than targeting to any activity. On the other hand, activity-based regulation focuses on activity being undertaken attempting to apply uniform rules to the activity across all regulated entities. For instance, the recent review of regulatory framework for microfinance loans attempts to provide a uniform regulation for such lending across banks and NBFCs by having a common definition of microfinance, same business conduct, and fair practice requirement, etc. I have touched upon the regulatory, basically our approach and what are the approaches and what is the intention of RBI, how to regulate the new innovations in a controlled environment. Now let me talk about what is the way forward for the FinTech sector. India has the third largest FinTech ecosystem in the world. While regulation can play a supporting role, FinTechs themselves have to ensure the balance between innovation and risk arising therefrom, and that will be my message to the FinTech. Naturally, the resilience of such an ecosystem will also inter alia depend on self-monitoring of the conduct of the constituents. Therefore, from the FinTech sector perspective, self-regulation can be a useful tool for setting and enforcing rules and standards. The sector should attempt to organize itself under a self-regulatory organization, which in turn can monitor the conduct of member FinTech entities. This approach can also help in the objective of protecting the interest of consumer and promoting high level of governance standard in FinTech entities. Role of such an SRO can include setting the standards for conduct as well as acting as a bridge between the sector and the regulators. Regulation is merely a guardrail to keep the sector on the right path. However, beyond its ability to innovate, the development of this sector will largely depend on two critical elements. And that is very important, and I expect and request all the FinTech entities and the innovators to really focus on these two areas. And these two elements are customer centricity and the governance. It is essential for the FinTech to keep customer at the center of their innovation and follow the high standard of good governance as part of their culture. While developing their product and processes, FinTech should ensure adherence to three basic principles from a customer protection perspective. The first, design robust customer-centric products that avoid FinTech-induced losses to customers, such as those from cybersecurity breaches, technical glitches, fraud, etc. Second, ensure customer suitability and appropriateness. Refrain from mis-selling or imprudent lending. Third, ensure that any inherent biases in the models are addressed in a fair manner. As far as governance is concerned, here I will a little bit give more emphasis. The importance of adopting and adhering to good governance cannot be overemphasized. Misgovernance at the root cause of several failures, and that is the experience speaks about it. For the sustainable development of the sector, it is essential that fintechs inculcate the value of accountability, fairness, transparency, and independence. The board of directors should be sufficiently empowered to assert its role as the balancer of conflicting interest of various stakeholders. It should have adequate experience and independence. Now let me conclude. In conclusion, the fintech revolution is well underway in India, and it presents us with a unique opportunity to drive financial inclusion, improve the efficiency of the financial sector, and create new economic opportunities for millions of people. The country has created a stack of open API and digital public goods which can be leveraged by the industry to innovate and promote financial and social inclusion. The Reserve Bank's approach has been to balance innovation with regulation without compromising on the principle of prudence. The fintech sector also needs to look into self-regulation and ensure that the issues relating to technology, ethics, customer protection, and data privacy are addressed. India has assumed the presidency of G20 this year, as told by Professor Bharat also, and the same gives the country an opportunity to showcase its leadership in the field of fintech, particularly in digital payment ecosystem. While India has made significant strides in developing its domestic payment systems, which are acknowledged globally, it can also contribute to innovations in cross-border payment systems. In this context, CBDC holds significant promise. With India already piloting its CBDC, the central bank digital currency, it is well poised to steer the discussion on the need for cross-border interoperability of CBDCs and developing standards for effective interfacing, so as to realize the potential of cheaper, efficient, and faster cross-border payments. I am quite hopeful that a number of papers in this conference will develop deeper into the opportunities and issues surrounding innovation, inclusion, and regulation in the area of fintech. I look forward to fruitful discussion which will push the debate forward and also provide some enlightening policy insights. I once again thank IIM Ahmedabad and Kafral for hosting this conference and giving me opportunity to address all of you. Thank you very much.